As advertised, Michael Wilson was once one of the original members of the three-person panel looking at independent oversight of the Upper Churchill MOU. He resigned with a letter on September 21st, and he joins us on line number 7. Good morning, Michael. You're on the air.
Good morning, Paddy. How are you today?
Very well. Thanks for asking. How about you?
I'm fine, thanks.
I really appreciate your time.
I didn't hear the comments you made earlier. I was working outside, and my wife came out and said that perhaps I should come in and respond. But would you mind sharing with me what you said, because I'm not actually aware of what the issue is.
No problem. I'll put all what I said to you here this morning, and I really appreciate making time for the show. So this is what Hydro is calling a fact-checker statement that they put out regarding points you made in your resignation letter of September 21st. 3 top areas that I'd like to discuss with you this morning are issues regarding inflation. One about inflation on present value, one on expected cash flows, and one on the annual assumption of 3.83%. Let's start there. They say in your analysis you use that rate based on historical data. They go on to say the rate is not relevant to the current deal. Their current expected inflation rate is approximately 2% based on the Bank of Canada's target rate, the Conference Board of Canada's forecast, and other market indicators. So they're calling out your use of 3.83. Your thoughts?
Okay. Well, let me start from the beginning, Paddy. As you know, I sent a letter of resignation to the government on May the 12th, and I had no response. Never asked me what my concerns were. I clearly set out my concerns about the impairment of independence. No response whatsoever. You also know, and I have sent you, as you mentioned, a significant amount of information where I prepared, I think now was probably four detailed analysis, setting out, various implications and outcomes set out in the MOU. And I've heard nothing from Hydro or anyone else. So it's pretty interesting to me now that they're zeroing in on one particular issue and one particular analysis. You know what? When I wrote my initial analysis, I think I was pretty clear that I hoped we'd be able to, by negotiation, get to a better outcome for the province. As time has gone on, it's very clear that that's not likely going to happen. The MOU is what it is. It's going to be turned into definitive agreements. And I think that is a travesty and a very, very unfortunate situation for the people of the province.
Well, my initial concern with the terms of reference for the oversight panel was it was strictly only what was included in the MOU versus other moving targets like East-West Energy Corridor, federal government involvement, financially speaking, and a variety of other factors. So before we get into inflation assertions, is when you talked about the impairment of independence of the panel itself, can you elaborate as to what that means?
Well, it simply means the panel's independence was impaired. That's simply what it means. Now, I can't divulge to you because of my non-disclosure agreement exactly why. And I set out to the government exactly why, in 3 very clearly articulated reasons why the independence, and I used the word became impaired, and wasn't impaired initially because I was there and I was very independent. But as a result of, I choose my words very carefully, information that was shared with me, I very quickly concluded that the findings of the panel, and certainly my findings would never be made public. That became abundantly obvious to me, and that's why I resigned. I wish I could tell you more. If the Premier would be so kind as to release my letter of resignation, I think those reasons for impairment will be abundantly clear.
So without betraying your NDA, because I don't want to put you in any peril, nor myself, so was there intervention by the government, and you don't need to be specific, intervention by the government after the panel was created, then consequently impairing the independence?
Sorry, did you say after the panel was created?
Yeah, because you say it became apparent that the independence was being impaired.
It became impaired, and I believe what you just said to be correct. Something happened that made me realize that the independence was impaired and that the findings that we were putting together would never see the light of day. Now, I can't say much more than that, and I hope that's clear, clearly understood. I'm limited to what I can say, but I will say this, that in my view, the findings that were being gathered by the processes we were going through, would never see the light of day. Now, if anybody wants to look at the independent panel report for July, it's on the icrop.ca site. Go read it and see what information you got from that. You got nothing. And I foresaw that happening, and I wanted to have no part of it, and I resigned. I waited until the panel's report came out because I was hoping I would be wrong. But when the panel's report came out, it was abundantly clear that they told the public nothing. Okay? So that's when I decided that I had to take some action, and that's when I issued my first analysis, which was based upon publicly available information. And in that analysis, I clearly stated that my objective was to challenge what had been said publicly in an appropriate way, to foster a discussion, an informed discussion, and hopefully get to a better outcome. Unfortunately, getting to a better outcome no longer seems to be a possibility. And that's why now I am certainly more forceful in saying this MOU, as it is right now, is a disaster for the province. Unfortunately, it's become an election issue, which, in my view, and others may disagree, should never be the case. This is way too important an issue. It shouldn't be a partisan issue. It should be an issue that's addressed by the people of the province after they have a very clear understanding of exactly what that MOU means to them and the future generations of this province. And I've listened to some of the shows that you've put on, and I congratulate you for keeping this issue alive. But the reality is, no one understands what they're being asked to vote on. And that is a travesty. And it's very, very unfortunate.
To that end, Mr. Wilson, so I hear all these calls for independent review. I mean, that has been the rally cry for the NDP and for the PCs, and this is always going to be a political decision at some moment in time. But independent review, if this panel was not acceptable, what would give you, and I don't want to put words in your mouth, would you have any cold comfort in additional layers of independent review? Let's just pick an entity, Deloitte, Goldman Sachs, whoever. Because when I hear people say an independent review, that's kind of meaningless to me unless we're highlighting specific concerns with where the money comes from, highlighting risk, trying to decouple Gull from the upper, all those types of very specific questions that we should be asking. But the vagaries of independent review, I don't think are getting us anywhere. So do you think an independent review would have any different outcome or feeling amongst the members of said panel or company if it was brought in?
Well, you said a lot. I'm trying to digest that.
Okay, let me boil it down to very quick.
My thought. First of all, in one of the significant amount of information I sent to you, I suggested what the public should expect from an independent review. And I clearly set that out. And what they should expect in the first place is clarity. What is this deal all about? What are these two pricing structures? And a lot of people don't even realize there's two pricing structures. And the reason they don't realize there are two separate and distinct pricing structures is because whenever anybody from Newfoundland and Labrador Hydro is asked about pricing structures, they'll always default to the one that relates to the existing Churchill plant. They will never talk about the other pricing structure, which basically gives Hydro Quebec all the power from the new developments at cost, with no link whatsoever to market, ever. And that's never mentioned, but it's clearly set out in the MOU for those who want to read it. And it's very seldom referred to by anyone who responds to pricing issues from Newfoundland and Labrador Hydro. Two separate pricing structures with very different implications for the province, each with their very, very different challenges and issues. So that's the first thing.
Can I ask a question on that one, though?
Pardon?
A quick question on that one. I understand, and I've read everything you've sent me. Is with the two pricing structures, what does the possibility of a single pricing structure look like when we're talking about a debt-free CFLCO, a long-existing hydro development at the Upper Churchill, a new construction at Gull with all the risk implications, what have you? So how would a single pricing structure actually work with two distinctly different beasts, with transmission, construction, and the existing dam at the Upper versus a new, yet-to-be-developed Gull?
Patty, again, you've said a lot. I'm going to try to digest that.
Okay.
I'm not suggesting at all there should be a single pricing structure. I'm suggesting that the pricing structure should be clearly explained to the public, because there's a lot of confusion. A lot of people I talk to don't realize there are two pricing structures because it has not been clearly explained. So let me just roll back. What I was talking about was what people should expect from an independent review. The first thing they should expect is clarity, providing an understanding of exactly what this deal is. And clearly, the public right now do not understand it. Hydro have not been able to articulate it. They've kept so many numbers that we can get into if you wish. They've stated so many numbers, but absolutely no support. They're not providing support for their numbers. They're not providing support for the things that they say to the public. So, secondly, first of all, an independent review should provide some clarity of exactly what's going on here. And secondly, they should be able to provide some analysis as to the outcomes that the province should expect. And right now, there's no clarity around that. And as you know, I have not done interviews and I have not called into your show because I didn't want to get into that argument about what the MOU is and isn't. I simply wanted to provide information so that people could read it, albeit I know it's very complicated and it's very substantial, but for those, my hope was for those who really were interested in it, they would take the time to read those analyses so they would be better informed and be able to come to a better decision. So it's, you know, in the absence of an independent review, the public just don't have a voice that they can trust that doesn't contain bias. If you go back to the Muskrat Falls report, one of the things that Justice LeBlanc said was, listen, when you've got proponents out there, they have an obvious bias. And when one of the reports that was produced by Professor Fieldberg, I think his name is, he said proponents will obviously, their behaviors will include an optimism bias, which means that they will accentuate the positive and underplay the negative. And that's exactly what's happening here. We're not getting it straight. We're getting a one-sided view of what this MOU is. And when other people, and I haven't called in, but when other people call in and say, hang on, what about this? They're accused to be naysayers and etc. So it's just so one-sided and biased that an independent review is the only way really you can say this is independent. These are people who have no skin in the game, not the people who negotiated the deal, right? Because obviously anybody who negotiated the deal thinks it's a good deal. Otherwise, why would they put it forward? But you need an independent view to say, is it a good deal? Is it the best deal? Hydro claim it provides the maximum benefits. Well, it's very easy to demonstrate that that's not true.
Yeah, I mean, the exact same conversation is happening in the province of Quebec to bolster your point of built-in bias, because it's nature of the beast, and unfortunately so. It's a political hot potato when this should be viewed as a pathway to a definitive agreement between Party A and Party B. The end. Mr. Wilson, now, I'm sorry, you want to comment on that?
I do, because that gets back to the bundling together of these two contracts.
Okay.
Party A, there's two parties here. There's not Party A and Party B. CF Alco is one huge player here, and CF Alco, their negotiation should have been CF Alco should have negotiated a new contract with their customers, who include Hydro-Quebec and Newfoundland and Labrador Hydro. The negotiating party should have been CF Alco, and it should have been very simple. We have the power. How much are you going to pay for it? And they should have negotiated as close to market value as they could.
Right, and I mean, I guess I should have said Province A.
Party.
Yeah, I guess I should have said Province A and Province B, or Utility A, Utility B, because
but it's important.
I think I understand my point.
Anyway. The second part is the province of Newfoundland and Labrador. The province should have been negotiating with Hydro-Quebec and Newfoundland and Labrador Hydro, because they are the proponents of this new development. And the province had the responsibility to make sure that the proponents of those new developments provided the best opportunity to the province, including all of their alternatives. So the negotiating parties weren't even correct from the outset, and that's why I said the MOU, for starts, is structurally flawed. The wrong people are negotiating here.
Mr. Wilson, a quick question. Now that I have you, either one or two requests. I can ask you to come up, put you on hold, come back and speak to some of the specifics from Hydro, or you can join us another day, because there's still so much more that I'd like to talk about. So would you like to go on hold, or would you like to try another day?
I know I'm on hold. I want to get this out there. I'm tired of this whole mess, and I want to get it over with. So I'm on hold.
Okay, let's do exactly that. Michael Wilson's on hold. Time for the news. Don't go away.
I am. Thank you, Paddy. Where were we?
Hard to say. There was a lot going on there. The basic last comment from you is that this MOU and the current structure and the negotiating team should have never been in place in the first place, or something along those lines. I don't want to put words in your mouth.
No, what I was really trying to say was the structure of the MOU was flawed, because the negotiating parties should have been, in the first case, CF Alco with its customers, and CF Alco should have negotiated the highest price it could possibly get, as any commercial entity would. And in the second case, with respect to the new developments, it should have been the province of Newfoundland negotiating with two proponents who are coming together mutually to make a proposal to the province. And the province should have negotiated with Hydro-Quebec and Newfoundland and Labrador Hydro, not them negotiating with each other. They were both proponents who both have interest in this development. So put that to one side. I was basically saying the negotiation or the MOU itself is structurally flawed, and I think that's quite evident. Anyway, let's move on to the next point.
Okay.
If that's okay with you, unless you have a question.
No, that's okay. I do have some questions, but where would you like to go next?
Okay, so as I was rolling forward, I started off by saying, letter of resignation, no response. Now, after that, as I mentioned, I put out, I think it's now a total of 4 detailed analysis. And in those analyses, the key findings are totally separate and distinct from any conversation about inflation or inflation rates. So, for example, I said that, providing Hydro-Quebec with a 40% perpetual interest in Gull Island, regardless of the price, which has never been substantiated or supported by an independent valuation, regardless of that, providing Hydro-Quebec with a perpetual interest in Gull Island is the same mistake we made in 1969. And giving them a perpetual interest in Gull Island means that forever, if it goes ahead, forever they will receive 40% of the profits from Gull Island. Now that means that even when the contract is ended, and let's say Newfoundland and Labrador Hydro or some third party buys the power after 2075, Hydro-Quebec will still get 40% of the profit. They'll get 40% of the profit from our power forever. That's just fundamentally wrong.
Right. The Hydro says combined ownership of all new developments, approximately 65% this province and NL Hydro, 35% HQ, Hydro-Quebec. How do we uncouple that? What you said is accurate as far as I understand regarding perpetual 40% stake at Gull, is how do we decouple that from Hydro-Quebec assuming the risk and the costs and the liabilities for construction at Gull?
Well, that's interesting, because Hydro-Quebec do not assume all of that. Okay, and I've also put this out in my analysis. And by the way, none of this, other than the inflation rate, has been questioned. So the reality is, all of the costs for these new developments will be entered into the accounts of the various entities. So the cost of the upgrade and the cost of the what's the other part of it? The upper. Anyway, they will both be accounted for in CF Alco. The expansion was the other part I was trying to think of, right? They will be accounted for in that entity, and those costs will be amortized over a 65-year period. This is in the MOU. Anybody wants to read the MOU, what I'm saying is factual. That means at the end of a 50-year period, about 23% of those costs, including cost overruns, are still sitting in CF Alco to be paid for by the future off-takers, whoever that may be. The same is true for Gull Island. In the fact sheet from, and I'm working from memory here now, but in the fact sheet from Newfoundland Hydro, they say Hydro-Quebec will fund the cost overruns. That's absolutely misleading. the cost overruns will not be funded by Hydro-Quebec at all. They will be accounted for in the accounts of the joint venture and amortized over a 65-year period. And at the end of a 50-year period, 23% of those costs will still be sitting there to be paid by the future off-takers, who could be Google or could be the province of Newfoundland and Labrador Hydro. So to say that Quebec is funding this is absolutely incorrect. It's a misstatement.
But isn't the cost overrun acceptance or liabilities or risk, isn't that part of the power purchase agreement? As opposed to just simply...
It is. You're absolutely right. It's factored into the power purchase agreement, but the power purchase agreement only lasts for 50 years. The costs are being amortized over 65 years. So there's 23% hangover there in the costs. Now, Paddy, we're getting down into the weeds, okay?
I'm not trying to do that. I'm actually trying to benefit from the information being shared here. And quick question with CFLCO in relation to Gull. My understanding is this is going to lead to some 10, maybe 12 definitive agreements, establishment of a new corporation involved with Gull, decoupled from CFLCO. Is that not how this works?
It is, absolutely. There's CFLCO, which owns and operates the existing plant. The CFLCO will be the entity in which the upgrades and the expansions will be capitalized. And by the way, that will be a result of 100% debt. So just stop and think about that for a second. Right now, we own 65%, I'll say 65% roughly, of an entity which has no debt and is probably worth, this is just a guess, maybe somewhere between $80 to $100 billion. Now that's just a guess. Don't hold me accountable for that. But I've seen other people's, calculations of that, and that seems to be reasonable based upon the cost of what it's going to be to build Gull Island. Okay, whatever the number is, it's a big number. Now, new debt is being put in that entity that we own 65% of. I say we because I'm talking collectively as the people of the province. Okay. That new debt goes in there, and the primary beneficiary of both the upgrade and the expansion is Hydro-Quebec. Now, you can go and read the MOU about how the power is allocated to them, etc., but they are the primary beneficiary. And the main reason it's being done, as I understand it, is to feed their peak needs.
Yep.
In the middle of January when everyone's got their heat on bust and they need power faster, right? There's very little benefit, if any, to the province of Newfoundland or to, I say, us as ratepayers and taxpayers. However, the value, the leverage, the value that we have in CFLCO of whatever number it is, 50, 60, 70, $100 billion, that's being leveraged to put that debt in there. So all of a sudden, our debt-free company, CFLCO, now has debt in there of, $6 billion. And that debt is being incurred primarily for the benefit of Newfoundland. Now, what do we get out of that? We get a fixed 8 to 10% return, which is not indexed, by the way. It's fixed over the period. So we get an 8 to 10% return on the equity we put in and the deemed equity put in. And like I said, now we're getting down to the weeds, Patty. I'm okay to go there if you can follow along with me.
I think right? I am. But isn't that return on equity based on 10-year bond yields from the government of Canada? And isn't that also...
No, not at all. The 10-year, that's again misnomer completely. The 10-year rate is at 8 to 9%.
Yeah.
Okay, and okay, so you're right. I see where you're coming from. So the 8% basically is the existing bond rate of 3.6 plus a bit of 5% risk premium. So there, the 8 to 9% is currently aligned with a 5% risk premium on the entity, on the business side of it, we'll say, and about a 3.6% Canada bond rate. But here's the point. This is the more important point.
Okay.
It's not about what it's based upon. It's the fact that we get 8 to 9% through the duration of 50 years. Now, it's not indexed. So what that means is, like, $1 today is worth, I don't know what it is exactly. I've got the numbers in my analysis somewhere. Something far less than that in 2075. But that 8 to 10% is based upon our initial equity. So that's like having an unindexed pension. That's like having a pension of $10,000 in 2025 and there'd be no indexing whatsoever for inflation, by the time 2075 rolls around or 2085 rolls around, whatever, that's like worth $500.
Yeah, and
we don't get any benefit other than a fixed rate of return on the fixed equity we put in, and that there's no inflation in indexing there whatsoever. So, and this is on the this is on the CFL new developments. The same is true for the Gull Island. We put in X number of dollars of equity, and we get an annual return on that of 8 to 9%. As a fixed number for the next, in the case of Gull Island, it's actually worse because it's fixed until 2065. So we get a fixed payment from when the assets are commissioned up to 2065, a fixed amount of money that is not indexed. So, for example, I think the numbers are basically, if you had $10,000 today, and it's not indexed, by the time it gets to 2065, I think it's like worth $320. That doesn't sound like a very good deal to me, Paddy.
I understand where you're coming from, and I'm only trying to add questions that I think are relevant.
No problem. I'm happy to answer your questions.
I know you are, and I'm appreciating your time. I'm always, ruled by scheduled break times and what have you, and I do have to get to one right now, Mr. Wilson. I appreciate your generous allotment of time this morning. Can we revisit this again in a couple of days or whatever the case may be, so I can carve out time so we can dig into another couple of areas?
I prefer not. I'm Paddy. I am absolutely exhausted dealing with this issue.
Well, how about this?
I'm exhausted dealing with this issue. I'm so frustrated dealing with this issue that the people of this province have been blindsided and continue to be blindsided. Like, I want to get it off my chest. I want to get it off my chest now.
Okay.
So if you can accommodate me, I'd very much appreciate getting the message to the people of Newfoundland now, because they are the people who have been forced to go to the polls and make a decision on this, and this is ridiculous. And I gotta get my points out.
Okay, so can I put you on hold one more time, because that's sort of how I'm covered. Okay, let's do that. Mr. Wilson on hold. Don't go away. Welcome back. Let's rejoin Mike Wilson on 7. Mike, you're back on the air.
Thank you very much, Paddy. So I was just thinking through it. So I think we've pretty much talked through the one pricing structure, which relates to the CFLCO expansion and upgrade. And I think we'll also talk to the pricing structure, because it's the same as Gull Island, that we only get a fixed rate of return and it's not indexed, so the value depreciates over time. So let's move on, okay?
Can I ask you a question about the expansion at the upper first before we move? So you're talking about what we get for. How do we factor in the quadrupling of the Labrador recall block to approximately 1,200 megawatts, which, if you ask people in Lab West, is an important facet of this MOU? How do you figure that or factor that into what we get from the upper?
Okay, well, that's an interesting point, too, because in terms of the allocation of power, I have no issue with that. I mean, they can allocate that power whichever way, CFLCO agrees to allocate it with its two customers. The thing about that is, and I think the comment is, we quadruple our access to power. The issue with that, Paddy, is that quadrupling takes place over 35 years. We don't get any power very, very quickly. And I can't remember the number now. I think it's like 2030 before we get any power. And then 2050, we get another 250 megawatts. And then 2060, we get another 250 megawatts. So anybody who's mistakenly led to think that, signing this deal all of a sudden is going to create 1,900 megawatts of power for Labrador West, again, is mistaken. They're not going to get it. It's going to happen over a 35-year period, which, again, is not very often highlighted when you ask this question of someone from Newfoundland and Labrador Hydro. They'll say, we get quadruple the power. They don't tell you it takes 35 years to get it.
I have indeed spoken to that time frame here on this program in the past. It was just a very basic question about how do we factor that into benefit analysis at expansion at the upper. Okay, you pick the next area you want to talk about before we try to figure this out.
Okay, well, I think because in my first analysis, I said, look, it's all about price, and price. So I'm just circling back to that, okay? And I'm just walking you through it. The first price was, what's the price we're getting for a 40% interest It's $4.8 billion. We've got no justification that that's anywhere close to what it's worth. The second area of price, we talked about that, is the price we get for the CF expansion and upgrade, and the price we get for the power from Gull Island. So we talked about that. But I'm not sure that I did say, though, from those three pricing sources, it's never, ever linked to market price. Never. It's always linked to the cost. It's like a cost of service model. And in one of my analysis, I said, look, Newfoundland and Labrador Hydro is treating Quebec like it's a Newfoundland ratepayer. They're not treating it as a buyer out of province that should be paying fair market value. They're treating it as like a Newfoundland ratepayer who should be paid at cost. Completely wrong concept of how a fair market value deal should work between two commercial entities, not between a generator of power and its customer, which is legislated to be basically cost. I mean, Newfoundland and Labrador Hydro, when they want to increase their rates, they have to go to the pub and ask for a rate increase because the pub is there to make sure that Hydro's rates are kept as low as possible for the public. That's sort of what's going on here with Hydro-Quebec. The price is kept down as low as possible instead of being at market value. There's a completely different concept here. Anyway, the point is that from the CF expansion, from the CF upgrade, and from Gull Island, there's no link to market price whatsoever. We get a fixed return at the value of which drops significantly over time due to inflation. Now, that's that. That's factual. You can't dispute it. I set that out in my analysis, and guess what? Hydro have said nothing about that. They choose to talk about a separate issue, which I will get to in a moment. Okay. Now let's move to the CF power, the renegotiated rate. And Patty, I'm going to I'll speak to this specifically, but I'll give you an analogy first. Let's say that you have a basement apartment in your home, and you want to rent it out to someone. And you check around, and the going price is somewhere between $1,300 a month and $1,600 a month. You get my analogy there, between 13 cents to 16 cents per kilowatt hour. But it's the average price of apartments are somewhere between 13 and 16. You're trying to gauge like what yours is worth within that range, and you just say, you know what, whatever. If I can get 1,300, I'll be happy. If I get 1,600, I'll be happier. But I'll take 13. Then someone comes along to you and says, well, I'll give you 270. And you go like, no. I'm not going to take 270. It's worth at least 13, maybe more. And then that someone says to you, well, how about I rent it for 50 years and I give you 13,500. Now, that's a big number, 13,500 for a place that's only renting for 1,300. What do you say to that? You're going to say, I don't think so, because that's still only $250 or $270 a month. So no, I'm not going to rent it to you at that price. That's what's happening with the power we're selling from CF, the existing plant.
Can I ask you a question about market value? Because this is one place where I admit to struggling. Because not every market is created equal. I mean, Hydro-Quebec customers are paying annualized average around 8 cents per kilowatt hour. And, if they service an AI data center at a commercial rate, or a mine expansion, or electric vehicle plant, or customers in the northeastern United States, like Connecticut, 25 years at 5 cents per kilowatt hour, that's where I struggle with market, because the market is different. Residential payers, commercial, industrial, the states, clearinghouse. So how should I be thinking about market insofar as price elasticity goes? Because it's never going to be just one thing.
Yeah, okay. So the best, I understand what you're saying, but the best indicator of a price of anything is an alternative replacement. And I'll just off the top of my head, I'll try to give you an example. Let's say you go to Hickman Motors, you want to buy a Silverado, and it costs $100,000, okay? And you go down the road and you look at a similar model at Ford, and it costs $85,000. Your next best alternative is what determines what your parameters are going to be. You're either going to pay $85,000 for a Ford or $100,000 for a Silverado. That's your two choices. And that's within that range. That's the market if you want a truck, 150, a truck, right? It's what I'm trying to say to you is it's the replacement cost. What your alternative is if you don't buy the Silverado, your alternative is to pay your next best alternative. The market value here is if Quebec don't buy the power from CF Alco, they have to build it. And if they build it, it's going to cost them 13 to 16 cents to build it. Therefore, their next best alternative is between 13 to 16 cents. So anything they get that's less than 13 to 16 cents is a benefit to them.
One more time, Michael, one more break, one more segment, because I want to pick up on that replacement cost, because that's something Michael Sabia said immediately upon return to Quebec. But I do have a couple of specific questions. Yeah. One more time on hold?
No problem. I'm here for the day.
Good man. Here we go. Michael Wilson on hold. Don't go away. Welcome back. Let's return our conversation on line 7 with Michael Wilson. Michael, you're back on.
Okay, thank you.
Replacement costs. Let me ask you a specific question. So Michael Sabia and other executives at Hydro-Quebec have said replacement costs in and around 13, 16 cents. My question to them would be, are they talking about having to build the amount of hydro available or any alternative source of energy? Because for those who use electrons, kilowatt hours, it's not about where it comes from, it's how much it costs. So are they talking about the inclusion of small nuclear, wind, solar, methane capture, or anything under the sun, or strictly hydro replacement?
No, I'm not 100% sure because I'm not inside his head. But I understand what he meant was if we were to try to replace power with a similar capacity, attributes of the hydropower, because all those other things like wind, solar, nuclear, they all have different issues and challenges. Whereas hydro is the pure source of energy, and that it's the storage capacity, the size of the reservoir. I mean, quite frankly, there's nothing in North America, perhaps in the world, I don't know, I'm not an expert in that area, but there's certainly nothing in North America that says that can generate the power and has the storage capacity, etc., of Churchill Falls. My understanding of his comment is to replace something like Churchill Falls hydro in Quebec at this point in time, their next best alternative is somewhere between 13 to 16 cents. And that's very, very indicative of what the market value is, because the replacement cost is a huge indicator of what the value is. In other words, if they don't buy it from Churchill Falls, right, for 2.7 cents, by the way, if they don't buy it from Churchill Falls, to build it, it's going to cost them 13 to 16 cents.
Yeah, I think it's an important distinction, because building hydro is different than relying on a hybrid of inputs, whether it be all of the aforementioned alternatives. So we invited Michael Sabia on. Of course, he didn't take me up on it. But anyway, that was one of the key questions I had for him. Okay, where to next?
Okay, so basically, as I was saying, I think we've talked through the CF upgrade and expansion and Gull Island pricing structure, at least as best I can, and highlighted the fact it's not related to market. It's a fixed rate of return that depreciates every year from now until 2065. Okay, let's move on to Churchill Falls, and this is the issue we're just talking about. I have put out an analysis which basically says, if you look at Schedule G and how it pays out, and you look at the power that Hydro-Quebec get, they pay 2.7 cents. And I also, in January, when the president and CEO of Hydro explained what 5.9 cents is, she explained a methodology or a model that would substantiate the 5.9 cents. I actually built that model. So I built that model, and I pushed it out there. It's there. Two models are out there. What I refer to as the Schedule G model and the Williams model. They both support a price of 2.7 cents. Neither one of them supports a price of 5.9 cents. There's no support being provided by Hydro of 5.9 cents. It's just not there. It's a number that they put in their fact sheet, but they have never produced a formula or a structure that supports that number. I have produced two that supports 2.7 cents, uncontested. They didn't respond to that in their response to the Group of 9 letter. Okay, so what I'm basically saying is we're getting 2.7 cents, and we just talked through, and I appreciate you making the points and the clarity. Hydro-Quebec's replacement cost is 13 to 16 cents. Why would we sell something for 2.7 cents when the next best alternative for Quebec is 13 to 16? And that gets back to my analogy: is why would you rent your basement apartment for $270 a month if it's worth $1,300 to $1,600 a month? You just wouldn't do it, right? Now, but besides that, just to drive the point home, in the Schedule G model, the price starts at 1.6 cents. Now, there's no relative connection whatsoever between a market price and 1.6 cents. But it escalates to 37.2 cents in 2075. And here's the kicker. 37.2 cents in 2075, discounted at the rate they use in the MOU of 5.822%, is worth 2.1 cents in 2024 dollars. It sounds like a big number, 37.5 cents. Oh, wow, we're all going to be rich. But the 2024 comparative number is 2.1 cents. Now let's look at it the other way. In 1969, I think the initial price, well, virtually certain, the initial price was very close to 3 cents. Oh, sorry, 0.3 cents.
Right. Yep. 0.3
cents. But if you roll that forward, accounting for inflation between 1969 and 2024, that 0.3 cents is now 2.6 cents. Okay? You understand that? No issues. That's a straightforward calculation. So in 2075, we'll be selling power to Hydro-Quebec at an equivalent price in 2024 for 2.1 cents. When the price we sold it to them in 1969, equivalent price in 2024, 2.6 cents. We're selling power to Quebec at a lower price 106 years after the price was set in 1969. It's ludicrous.
In round numbers, when they talk about 17 billion, because people can talk about price per kilowatt, megawatt, what have you, in the round numbers, average $1 billion a year between now and 2041. Then they look down the path to 2044 at $2 billion, 2060 to $6 billion. I think those are there's nothing bite-sized about saying billion, but I think in the overall scheme of things, price per kilowatt hour, megawatt is maybe lost on a lot of folks versus X number of millions or billions. Just a quick, when we talk about value for new developments or return on new developments, this is one of the points made by Hydro. Mr. Wilson estimates a return of $20.5 billion on new developments. Our projections show a return of $47.8 billion. Mr. Wilson's estimates lack any supporting calculations to analyse for differences in conclusions. Your thoughts?
Well, I'm pretty sure that in all the analysis I've done that I supported that number somewhere. I can't tell you where exactly, but I'm sure it's supported. But let me tell you another perspective on it. When you look at that 227 billion number that they put out there, they come down and they show an operating profit from all the new developments. Well, here's the confusing thing that they haven't clarified. As I said to you, all those contracts for the new developments are on a cost-plus basis. And what that really means is the revenue will equal the expenses. So the profit will be zero. That's what cost-plus means. Hydro-Quebec is not going to pay any more than the cost to generate, which means that it cannot generate a profit. Yet they say the profit is X, and we get 60% of it. But the MOU doesn't support the fact that there's going to be any profit as such. What it supports is in the cost build-up that Hydro-Quebec pay, there's a factor in there for the return on our investment of 8 to 9%, which is factored into the cost. Quebec will pay the total cost. The revenue will equal the total cost, and the profit will be zero. So all we get from the expansion, and I've already mentioned this earlier, but all we get from the expansion and the upgrade and Gull Island is a fixed return on equity. There will not be any profit generated through those contracts. That's not the way a cost-plus contract works. So I completely do not understand their comments. And my $20.5 billion basically is I calculated, and I know where I came up with the number, and I'm sure it's out there somewhere. Maybe I sent so much information to them they didn't have a chance to look at it all. But basically what I did was I said, okay, so what is the equity component of each of these investments? And what do we get on an annual basis at 8 to 9%? And then I basically factored that, and it comes up to I think, $20.5 billion. So I put that number out there. So I don't understand why they haven't seen it, because it's out there. And I also don't understand how in their summation of the $227 billion, they can allow for a profit on a contract which is designed to break even. It doesn't make sense. And Patty, the thing about it is that I shouldn't be, and nobody should be trying to work this out. This information should be readily available and provided to the public by Newfoundland and Labrador Hydro. I shouldn't have to try to work it out, and that's why there's such a lack of transparency here. They've made statements, and they put huge numbers on a piece of paper without any supporting documentation as to how these numbers are calculated. So anybody who's trying to understand the MOU has to try to work out what the heck they're talking about. So that's why there's a difference between the $20 billion that I suggested was the return on equity, and the number that they suggest is a 60% split of a profit, which in a cost-plus contract doesn't exist. So it's just confusing, and there are two numbers out there. One of them is right, one of them is wrong. But I've supported mine, but they haven't supported theirs.
Is what you refer to as the discount rate calculated inside what Hydro will refer to as the capital asset pricing model? And then you talk about equity risk premiums and all the other very technical economic jargon.
That's getting pretty technical, but the capital asset pricing model basically is a way to try to determine what's a reasonable discount rate.
Right.
So let's talk about the discount rate for a second, okay? Because I think I've made my points on the pricing issues, right?
Okay.
So the discount rate. So first of all, what I'd say is everything I've just talked to you about, the price for Gull Island, the price, the fixed return we get on the new developments, the pricing numbers on whatever, they're all, the last one is determined using a discount rate of 5.83%. Now, when I looked at these numbers and I was trying to look at them, where are our risks as a province? And what I looked at was a 5.822% discount rate over a 50-year period is not very much when you look at the fact that historical average rates of interest have been 3.833%. I lived through, I'm 72 years old, I lived through inflation at 12% and interest rates at 18%. No one has a crystal ball to know what the inflation rate is going to be in the future. But when you use a discount rate like that, what happens is that the present value of all the future payments gets locked in at a particular discount rate. There's no escape clause from that. It's locked in, it's long term, and that's what establishes the value. Now, if inflation exceeds the expected rate in that 5.833% or 822%, whatever it is, right?
3.83, yeah.
Yeah, well, if inflation actually exceeds the estimate of inflation that's in that rate, we lose and Quebec win. Because the future value of the money as inflation goes up or as the discount rate should go up, we would lose. But that discount rate is set for the full 50 years.
Yeah, I guess that's why out clauses in 51 and 61 are part of this, and whether or not they're achieved in a definitive agreement or a contract remains to be seen. Mr. Wilson, for starters, I really appreciate you making time for the show and the information that you've shared with me. I do have to get to the break. I don't know if you have anything else that you'd like to say here this morning, and I'll leave that to you.
Well, you know what? There is a few things I'd like to say, and it's in summary, right? Is that, look, unfortunately, and I think it's really unfortunate, people are being asked to make a decision on this MOU without the appropriate information. And there's a lot of information that Hydro should have provided to the public that they have not done so, which creates a lot of confusion and causes people like me to try to work it out, which we should never have to do. That's the first thing. The second thing is, how can we be comfortable that a 40% interest in Gull Island is only worth $4.8 billion? how can we be comfortable in selling power to Quebec at 2.7 cents when the replacement cost is 13 to 16 cents? And how can we be comfortable, getting a return on the new developments, which depreciates over time, and by the time we actually get it, it's worth nothing or very, very little? How can we do that? How can we support an MOU that results in those three outcomes? Now, having said that, there's a lot of other issues that a lot of other people have raised, which are very, very valid concerns about the control of the river, right? And about other aspects of the MOU, which I haven't touched on because I've basically stuck to the pricing. And I think the pricing is atrocious. And if people are being asked to vote on this, they better be very, very, very careful about how they cast their vote.
Price, cost, value, all inherently linked but distinctly different. Michael, really appreciate this morning. Thank you very much.